Good evening, ladies and gentlemen. Today is the 30th of August, and after the Fed speech on Friday, US markets closed at the lifetime high and we had huge positive sentiment. This morning we opened gap up, and so if we think about it, on Friday morning, the 16,600 straddle was pricing in an upside of barely 16,800, but we opened above 16,800 Monday morning, and from that steady up move. Initially, Bank Nifty looked to be underperforming, and but as the day played on, just a continuous one-way up move on Bank Nifty, and IT as well was dipping mostly because the USD INR got smashed, and so that's not very good for IT companies. And yeah, all said and done, I was carrying a double diagonal on from Friday, and right in the morning, I had to make some adjustments to ensure that the upside didn't hurt me as much. So I made the necessary adjustments, and those adjustments protected me immensely. In fact, I entered the adjustment in two phases. One, I initially just moved up my puts and then moved up the hedge at a point where it made sense. But the markets being the markets, we had a super one directional upside move coming in from Bank Nifty, which despite my adjustments protecting me for about 4 lakhs, still putting my position at threat. And I had two options there. One was to do an adjustment. So an adjustment there would have been to either create a large amount of broken wing butterflies or to create calendars which are further in the money. But they really won't have that much meat, because a calendar where I sell this week's option and buy the monthly option will not have much theta value available to it to begin with, and or instead just shift the entire trade. And I went over those options, but I didn't do it because right now, with Bank Nifty breaking the range that it has held for a very long time, if it closes here, there is potentially a lot of room for further upside, and I don't want to delta neutralize my trade and try to manage from there. So I think the best thing to do would be just take an exit. On the overall trade, I booked about 1% of loss on the margin that was used to take this trade, and on my capital about less than 0.5%. And that's like something that I want to drive in, that you don't have to fight every trade. If that trade is going against you, just you've done some amount of management, but then you don't want to over manage that trade to a point where your initial view is something else and then now you're sitting on something else altogether. Because while I could adjust the trade in a manner wherein by tomorrow morning, if we open flat, the trade would be in a profit, I think it's prudent not to do that, because there is a huge amount of proportionate risk. There have been some more attacks, and right now US markets are flat as hell, right? So they're completely flat, and there have been some attacks in Kabul and whatnot, and because of that, if there's some profit booking, once again, even a slight dip, after adjusting at an all-time high for upside, the downside can be painful, and I would just rather not have to deal with any of that. So yeah, taking a backseat, and yeah, we'll catch you tomorrow. We'll take a look at how the risk to reward for trading intraday is. Today was crap, which is why I didn't do it, and we'll see how it is tomorrow and day after. Thank you so much for watching, and in this video I've also covered like a few basics of double diagonals and when to do them, how to do them. In fact, because my trade was a double diagonal, not something like an iron condor, I had a lot more flexibility and room to work around the trade. And the reason I was able to get away with just, I entered the trade when we were at 16,600 and exited it at 16,900, which is a 300 point move. And still, I mean, it's really not bad to take 0.5% on that. So yeah, I've covered some of that. I hope you find that useful. Thank you so much for watching. Take care.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. The time is 10:21, and we opened this morning with a pretty massive gap up. The risk reward to triangle is not great, which is why I do not have any triangle position. I carried two double diagonal spreads, one on the Nifty and one on the Bank Nifty. And this morning I had to very quickly make some adjustments to deal with the fact that we had a continued up move. So I bought back my 35,400 put option and sold the 35,900 put option. I also bought back the 16,500 put option and sold the 16,800 put option on the Nifty to now make my Nifty and Bank Nifty trades look like this. So given my current Nifty trade, my upper break even almost reaches about 17,000, and my lower break even is almost 16,700. But the thing is, it will improve as I will be moving up my hedge as well, but mostly towards the end of the day. The 16,200 hedge will be moved up to 16,500, and likewise with the bank Nifty, where my lower break even is now 35,500, and will be moving up the hedge from 35,200 in the monthly to 35,500 in the monthly. So the idea is into the up momentum. I don't want to be buying put options as a hedge. I'll rather wait. Or if either of these expand till, if this expands till about 120, or this expands till about close to 500, then I will be moving into the hedge. Meanwhile, my hedge will be placed lower down. So by doing these quick adjustments, one thing is that this continued up move is more or less neutralized. I had booked about on the Nifty and Bank Nifty together about 1.6 lakhs on Friday on the double diagonal spread, and yeah, overall at the very least it is a little bit better than break even from where the positions are currently. So that being the case, we'll keep you posted. There's a lot of strength, continued up move. The thing is, I don't have to be worried too much on the upside, mostly because in the payoff, these long options, so the monthly long of 36,300 and the monthly long of 17,000 are doing very well in order to defend the position. And this is why diagonal hedging can work out really well. All that being the case, we'll keep you posted. Time is 10:24. I'm not taking any intraday trades, so it's not like there'll be any super active management to be done. Yeah, we'll keep you posted on if and when I do take any intraday trades or make any changes to the diagonal position. Okay, so I finally moved up my hedges, more or less because finally there seems to be some arresting of momentum on the Nifty and the Bank Nifty both. So since the momentum has slowed and monthly options have crashed quite a bit, I have sold off my 16,200 monthly hedge, and I purchased the 16,500 monthly hedge. And on the Bank Nifty, sold off my 35,200 monthly hedge and purchased the 35,500 monthly hedge. By doing this, more or less, what this kind of ensures is that if there is a reversal, then it will not really hurt my position. And so basically, this is what it looks like now, the position on the Nifty, and this is how it looks on the Bank Nifty. And this is assuming that, and this is considering that these positions have already booked some amount of profit. Today, once again, we'll be booking about, I think, 250, 260 negative on this position from what will show from tomorrow's market. But the idea initially was I had to make this adjustment quickly because there would be momentum on the upside. And whereas any further adjustments which are not really required at this point on the Nifty especially, on the Bank Nifty especially, the Nifty might need some amount of work to further buffer the upside. That I can do towards close, that I don't need to be in a rush. You only have to be in a rush when your position is in a very dicey situation where it's reaching the break even, or suddenly your gamma is going to shoot through the roof, stuff like that. So anyway, what I've decided now is I will use today, since I'm not doing an intraday trade, to go over how exactly a double diagonal trade works, and in general how understanding how your trade will function will give you a better opportunity to fix it in case things start going wrong. And yeah, so let me get into that. Oh, one more thing to note, in all of my adjustments, I've ensured I've not used any additional capital. There are other ways of adjusting, and some people, what they try to do is they will try to overpower this trade, like by giving it a lot more potential decay. So this is one way of doing it. This additional trade would require a margin of about 1 crore, let's say. So what they would do is they would add something like this and then force the trade to give much more of a theta decay in this very range. So what they would do is, rather than correcting for risk, which has been done in a way, they would also be adding a lot more risk in the direction of the upmove. So let's say because a lot of people will feel 36,000 on the Bank Nifty, 36,200 especially good resistance. So why not add a trade like this? The issue is, if tomorrow we open at 36,500, then you're at a very very bad situation. And so my approach is, as much as possible, do not try to overpower a trade with capital, just to come out of it profitability immediately. Rather, give it time, let it play out, and as and when you are, it's prudent to make a change, make it, because there are many people, like you can sell 36,500, 37,000, and you can sell 35,500, 35,000, or rather than even, I mean, the calendar is probably a safer way of doing it. Some people might just want to add like 100 lots of this and make it like this. Now it looks like, okay, you can get very good decay in this range. And I just don't agree with that approach. I think there is a certain time when a trade has to be overpowered, but not necessarily into mild moves. What that'll end up doing is that'll put you in a situation where you've used up too much of your margin, and in case the trade further goes against you, then you have absolutely nothing to do. So in the adjustments that I've done, actually there's absolutely no additional margin required. The quantities are the same. It's just moving around of different legs. Okay, so let's talk double diagonals now. I have this particular trade and this particular trade, both of which are open, but I'll build a new trade just to go over how the concept works. Now, generally people tend to make this very complex, and like most people are uncomfortable with double diagonal trades because one, you can't calculate the break evens properly. You can't really know what the payoff is, so you don't know what the max profit, max loss is. Adjustments, it's a very, very flexible trade. That means that there are 50 different ways that you can adjust it, and there's no right or wrong way. It just depends on what the situation is and what your view is. And whenever there is that level of flexibility, people invariably think of that as level of complexity, and they shy away from stuff like that. But it's actually a very simple trade and quite good for the kind of situation that we are in. So let me just take the example. A double diagonal trade is nothing but you create a short triangle, and everybody, to a large extent, and you're just going to take random strikes now, like equidistantly. So you create a short triangle. Everyone knows how to manage a short triangle, more or less. Gives you positive time decay. As long as it's in between your strikes, you don't have much to worry. In case the trade starts going against you, at the right points, you shift either leg in, or you can even shift out the losing leg. Most people don't take the shifting out approach because they have to give up credit, and most of the time they assume that their initial strike was wrong. It's not the best thing, but anyway, that's how they manage a short triangle. Now, to hedge this, what most people would do in an iron condor format is they probably buy in the same expiry, and so they buy. So this becomes an iron condor, right? Everyone understands how an iron condor works. More or less, you would manage it the same way you would manage this triangle, just that you move the hedge along with it. But the problem with an iron condor is that when premiums are very low, basically volatility is very low, people say, oh, we're getting shitty premiums and a small move is leading us going into a market loss very easily. Then a better way of doing it is, because whenever the perception of risk, IV is nothing but perception of risk, goes up, the later dated options and the later dated insurance obviously will go up more. So the idea is, rather than buying these hedges, which you know anyway are going to go to 0, 100%, you buy later dated hedges, because everyone's saying options are cheap, options are cheap. Well, if options are cheap, then buy the options, right? But you exactly don't know how to buy in a way that it makes sense. So instead, take a position like a short triangle, and to hedge it, buy later dated options. So let me say I buy this, not to become a calendar, we would buy it, let's say 37,000. Just for simplicity's sake. And here we can buy the 35,000. Okay. So now this is what is called a double diagonal. You have a short triangle here, and you are buying a long triangle. Why? Because you are assuming that at current prices, the risk is being priced in very low. So most likely that the pricing of risk will go up. And the way I see it currently, this is my personal way of looking at it, is a double diagonal has to be initiated whenever you're not expecting a massive crash in IV. You're not necessarily expecting a big rise in IV, but you're not expecting a massive crash. So the way I see it currently, I think below 15 India VIX is a good time to take a double diagonal trade. If we reach towards 10, then it's probably better to go with a calendar, where I'm assuming that India VIX will stay between the range of 12 to 15 for now. Let's work with that hypothesis. So if it goes below 12, then calendars are more attractive, because there your exposure to the bot option, which means if the bot options gain more, you will gain more because you have higher risk on the bot options in a calendar. Whereas in a diagonal, since you're spacing it, you're not taking the same strikes. If you took the same strikes here, then it would become a calendar. I'm doing this on the fly, so in case you have to rewind and listen, I think you should do that if I'm not being very clear. Basically, if you take the same strikes, it becomes a calendar, but you're taking different strikes. And in a calendar, right, your exposure to increase in risk is more. That means if IV shoots up more in a calendar, you will profit more than what you will in a double diagonal. Anyway, so you have sold one triangle and you have bought one triangle. This is the double diagonal. Now, this is more or less the best way to describe a double diagonal is it's like an iron condor, just that your mark to market won't shift as quickly with slight moves. So it has a flatter payoff graph towards the center. The rate at which an iron condor would shift, as in when the market moves a little up and down, would be more than that of a double diagonal, provided there is no big crush in IV. Now, one big threat to this trade is a big crush in IV, where these bought options lose a lot of money because your sold options can only lose so much, and before their expiry they can't give up and become zero, right? So that is one big threat, and the way to manage that also is that, but I'll get to adjustments. This trade is supposed to be taken, in my opinion, as long as India VIX is below 15. This is a good trade, and on the lower side, if IV starts falling, then there's a particular adjustment that you have to do, which will be converting this into a ratio wherein your sold position will be more than your bought position. You'll have to add some decay, like literally add some theta decay to it. I'll get to that. Okay, how do we manage this position? Now, depending on what you're adjusting for, there are a few ways in which you can manage the position. But the first and simplest way that everyone will understand is if you're ignore this long strike. Just look at this short triangle. If your call is gaining and your put is giving up, if the market is heading higher, then the same way you would adjust a short triangle, just take in more credit from your put side. So you will move up this put. But the problem there is that this call would have gained and this put would have lost. And in case there's a reversal, this put will bleed. The put that you've moved up now will bleed more than its hedge. If you haven't got that, just play that again. You're moving up just your sold leg. You are not moving up your hedge. So in case there's a reversal, obviously you will bleed. So there is a reversal risk wherein, and the biggest risk to this trade is this put option losing a lot of value. This call option gaining is not your problem. This call option not gaining enough is not your problem. Your biggest problem in this trade is how much value this 35,000 put option is going to lose. So that is one risk that comes in. So it depends on if you believe that there can be reversal, it is prudent to also move up your hedge. Now similarly, let us say you're adjusting for a crush in IV. There is a steady fall in IV, but if there's a steady fall in IV, it most likely is coupled with the fact that we're also very range bound. So it must mean that we're holding range, but your long options are losing money. So at that point, one option available to you is add more decay. So how can you add more decay? You can add iron flies here, you can add an iron condor here, you can add strangles to this. You can convert this into a ratio where you have sold, let us say for every 1.5 lot that you've sold, you've purchased one lot as a hedge, or you can even, if you want to be aggressive, you can do 2:1 and things of that nature. But then that again would require additional risk management once you take such a position. Okay, so one more thing to be aware in terms of adjustments is always be aware of what it is that is either the credit or debit that is happening. And obviously understand that whenever you are taking in credit trades, it means that you will have more decay, whereas whenever you're paying a debit, obviously you have a negative decay. So depending on that, there are many things that you can do to adjust in case there is a directional move. One thing that can be done, and I'm first talking about all the trades which do not require additional capital, is into an up move, you can move up your call. Rather than moving up your put or rather than doing anything else, you can just move up your call and make it go closer and closer to the hedge until the call itself becomes a calendar. What that will do is that into the continued up move, your bought call has remained exactly where it is, but your sold call, you've been moving it up at different points. So overall, into the up move, you have not taken as much hurt, and there is not a large reversal risk in this position. So that is one way. Here, however, because you keep moving up your call, it's technically a debit each time. You are paying more to buy back your current sold call position, and you're receiving less for moving up your call. So that is another form of adjustment that can be done here. Now, in case you want to keep this particular position and you want to add something that will benefit you in turn of move, so one good thing that can be done here is buying another calendar. So let us say at 37,500, right? So 37,500. we sell this, and in 9, sorry, we have to buy that. Yeah, we bought it, right? So what exactly does this adjustment do? This particular adjustment on a standalone basis, yeah, that's fine, would create a trade like this. So what does this trade do? This trade ensures that as and when you have an up move, you actually benefit, and you're paying a very small debit, and this will have a great risk reward ratio of 3, but it protects against a continued upside. So given that your existing position, if it is starting to reach a point where the upside is bothering you, you can add a trade like this, which is adding a calendar. Now, once again, the thing about a calendar is most likely you need a certain outcome to play out. If not, you're going to be paying a certain amount of money. So you will be giving up this money, which is limited, but at the same time you will be giving up. So that is the cost of doing that. Now, the other thing that you can do is actually most things are based exactly on this. Either you move your short legs in closer and keep taking in more credit if you want to take credit and you expect a further holding of the range, or you add calendars, or you convert your existing positions more into a calendar type situation. And the most aggressive way is to move only one short leg without moving the hedge and trying to benefit from that range. It opens you up to quite a lot of reversal risk, which is why you should set a re-entry criteria wherein you absolutely move your hedge up, which is exactly what I did today. The reason I did it is because of my sizing. In case that trade then once again reverses about me, it won't hurt too much. Because overall, if you see, I'm not using more than about 30-35% of my margin to take these trades. So I will invariably be able to take further corrective action in case something goes against me. So that's about it. I think more or less it isn't super in depth. I'm not telling you that when it goes here, do this, when it goes there, do that. These are all options that are available to you, and there is no one way of managing this trade. This is not the kind of, I mean, there might be a situation where you might have to roll over the entire trade because of how the trade is going against you. You might take your entire short options and switch them to the next expiry. There are all kinds of ways to deal with it. I think the best way to figure this trade out is to practice it yourself. So either if you're already quite well versed with how these things work, you can practice with a single lot, or you can try to paper trade it and eventually try to deploy it in the live market, because there's no way a trade like this can be figured out on paper, and there's no one who will tell you, because there are a lot of variables here. There are different expiry dates, so there is no clear-cut picture as in like somebody will tell you at this delta you switch your position. First of all, I never checked the Greeks, so I wouldn't even be able to do that. But there is no one structured way of approaching this. So I hope this was useful. I think what I would rather do is like leave your questions specifically, like specific questions in the comments, and I'll try to answer all of them, which all are related to double diagonal in quite a detailed manner. I'll probably make a video tomorrow answering all of those questions. Yep. For now, not a lot happening. We're more or less holding range. One of my concerns now, being that it's a Monday, will be that tomorrow and day after, in case my short position does not have too much credit that it can give up, and that too now since it is in the form of a triangle, it will have maximum theta decay only when my triangle is centered. I'll have to see what I do towards the center. So towards the close, I might make some changes to my short position, or at least add a few legs which are OTM, so that I can have a little more decay. Because one issue that I will face now that I've moved my hedges up, is I have to start worrying now about my hedges also losing quite a bit in case we hold range from here. I'll keep you posted. Time is almost 12 o'clock, and it's been quite a bullish first half. And the thing is, the bullishness is coming from the broader market. It's not like it's Bank Nifty taking off, or IT taking off, or Reliance taking off. It's just the entire market is moving up. Okay, the time is 2 o'clock, and Bank Nifty is extremely strong, and it has now reached this area, which has previously acted as a resistance. But with the question is, if we start to close above this, then I will not be carrying my trade. In fact, I'm basically at this point trailing a stop loss to exit. The kind of adjustment that I would have to do to deal with this, for example, this is my Bank Nifty position. It's currently losing me 1.5. I've already booked 86,000 profit on it, so it's losing me about 70,000 or so in reality. And my Nifty position also is now losing me about 1 lakh, and I've booked about 75 on it, so it's not so bad. and the adjustments have done really well to protect against the up move, and the fact that it's a double diagonal instead of iron condor situation also has helped, because the hedges, both this and this, have done a lot of work to defend the position. But now in terms of how it is that I would have to adjust this, if I want to carry this, is first of all, why would I carry? We're now taking out an all-time high on Nifty. There is potentially a reaction that will come out in the US markets tonight after the attacks that were made in Afghanistan, and could go either way. And right now, the only way I would have to adjust a position like this would be by doing something like this. So by essentially creating a spread which is delta positive and will cover for whatever negative delta my existing spread has, and adds more theta value. And this would give it a break even of 35,700 and 36,800. However, given this kind of a move, after this kind of a move, carrying a non-directional trade is not necessarily a good thing, especially with such little time left to go for weekly expiry, since I'm dealing in weekly expiries. So the best adjustment according to me here, I mean, there are different things that can be done to neutralize this trade and make it look nice and even around the center, so that one day's decay will put you in profit. But I don't think it's worth it. I don't think it's worth it, mostly because if you see on a broader time frame, multiple times we've come here and been rejected, come here, been rejected, come here and been rejected. And the, let's say I adjust for being neutral around this point. If we break out or we get rejected, either way it goes against me. So I don't really see why I would have to do something like that. And all said and done, I think coming into the up move, considering this double diagonal I entered on Thursday, and since then had to deal with this continued up move, I think all said and done with the adjustments, because just these adjustments alone today, even though I bought the hedges also for the adjustment, have saved me around 4 lakhs. So that's the thing, right? And I don't want to once again add more capital to this trade and then try to do something. I will instead just call it today, and I will wait and see what happens and react accordingly. We'll keep you posted. At this point, if we more or less breach on the upside by another, I'm looking at it as a mark-to-market trail on both my positions put together. If I'm losing another 50,000 or so, I think that would be a good enough cue to exit. Since I do have diagonal hedges, that's one of the reasons I've been able to hold on to this position as long as I have. Okay, there's a slight pullback candle on the bank Nifty, and I don't think I'll be getting much more than that. So I will be exiting the bank Nifty position at whatever price I'm able to get. Mostly because beyond this, it doesn't make sense to hold the trade. Now I will get slippage, but can't do much about it. So I'm exiting this entire chunk in one shot. Doing it in 10 lots at a time, but even then I will get slippage. Now as I place these orders, you can see that my mark-to-market will worsen, mostly because there's really nothing that can be done to avoid the slippage, especially when you're dealing in the money options. Even if you place smaller orders, not much I can do. This is one of the things that's really crappy about positional trades, that exiting can cost you. And Nifty as well. Yeah, not a lot I could have done there. I think my adjustments in the morning were fine, and there is potentially more fighting that could have been done in order to protect against an even more up move and then try to actually come out of the trade profitably. But I just don't think it makes sense that now that we are breaching here on the upside, that I try to fight it aggressively. A lot will also depend on what happens tonight. But yeah, sometimes the best adjustment is to not do any adjustment and just exit the trade. So let me just go over the summary of this. Okay. So on Bank Nifty, had to book a loss of 2.27, mostly because of the kind of slippage I got. And on Nifty, I had to book a loss of 1.87. So roughly in both the positions booked together, about 4 lakhs of loss booked. On Friday, I booked about 1.6 of profit. So you can say between the two of them, 2.4 lakhs is the loss that I've taken. which is fine because between both of the positions, my potential profit was in line with about 8 to 10. And on the margin used, roughly, that would work out to actually less than 1%. Because it was close to about, I think between both positions, it was close to about 1.8, 1.9, okay, about 1% or so of loss taken on the margin that was used for this. I guess that's fair enough. These are all trades which are covered calls, and they are covered completely by my stocks. So I'm not too concerned about this. I'll see what to do at a later point of time. But yeah, right now things are in a mad bull run. I think one of the reason my position was manageable to a larger extent was because of the fact that I had diagonal hedging, and the long calls definitely helped me. So that's about it. Yeah, so thank you so much for watching. I'll see if there are any opportunities for trades tomorrow. Will not be trading on the first because we have this whole no trading thing that a lot of us are participating in, and it's a way of raising our voice against what's happening, where our administrators don't even have the decency to give a response as to why they behave the way they do. And I think it's like a silent protest, not silent but a non-violent protest that we're doing, and really there's not much else that can be done except for at least try and get our voices heard. Who knows, maybe because of dip in volumes, people talk about it on news channels, and maybe I don't know, we do what we can and we hope for the best. I guess here there's really not much else apart from hoping, unless people have the intention of probably switching to a different country and trading in those markets, which will be almost an impossibility for everybody. So thank you so much for watching, and I will catch you tomorrow. Take care. Bye bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.